Well, the Bank of Canada is holding its key lending rate at 2.25% as it weighs numerous economic headwinds, including, of course, the volatility caused by the war with Iran. They include the impact of the war and recent data on inflation. The CBC senior business reporter Peter Armstrong joins us now with more on the central bank's decision. We did hear from the governor of the Bank of Canada last hour, sort of giving us a little bit more context here.
Yeah, and of the sort of dual crises that are facing the Canadian economy, because we're still, of course, dealing with the fallout of a year of volatility and of uncertainty and of tariffs and of threats and of trade wars, and that's having a real material impact. We're all feeling it. But then you add in all this new volatility, uncertainty, and economic turmoil from the war in Iran, and it's a tricky spot. You know, they don't write a lot of folk songs about central bank governors, but this is a difficult position for anybody trying to figure out how to navigate and thread like a bunch of needles in a row here. So Tiff Macklem has these two problems. The Canadian economy is slowing and inflation looks like it's going to rise. And how do you sort of manage those? Because the policy response to the two different things are in fact the opposite from one another. Let's take a listen to how Tiff Macklem framed the issue.
It's still too early to assess the impact of the war on growth in Canada. If higher oil prices are maintained, this will boost incomes from our energy exports. At the same time, higher oil prices squeeze consumers, leaving them with less income for everything else. Beyond the jump in energy prices, the war in Iran will affect households and businesses in other ways. Financial conditions have already tightened. Global bond yields are higher, stock markets are lower, and credit spreads are wider.
And I think, Arthur, the point that he's making there about sort of, bond yields and equity markets, they're already reacting. And so you've got these like projections of what things might look like going down the road. You've got this pent up year of volatility and uncertainty, and then you've got markets reacting already to what might be coming. It is something of a perfect storm and a really difficult policy spot for central bankers to be in.
And of course, we know that one of the questions was, how long could this last? And duration is a big part of this all, because trying to navigate this all, not knowing how long the U.S. trade war is going to go on for, or, of course, this war. So with all of that, how is the governor looking at what comes next? So
the bank's job, the central bank's job, is to monitor inflation and to change interest rates. That's its lever to try to manage that. With that in mind, what he's looking for is how quickly and how broadly does, like we've all seen a rise in the price of gasoline, right? You drive by the gas station, whether you're on your bike or walking or on a bus, you can see it, and the numbers are pretty high popping. They're shocking. The question is, how quickly does everything else rise as a result of that, right? We've talked about this before. Oil, gas, like the lifeblood of an economy. So it's not just about me and you filling up at the pump. It's about shipping. It's about moving cargo. It's about powering your factory, whatever it is. Managing how that spreads, or monitoring how that spreads into the broader economy, the persistence with which it spreads, the speed at which it spreads. That's what the bank is watching for, and that's what we're going to be looking for in terms of its next decision.
Okay, and we know the U.S. Fed Reserve decision coming out as well, too.
Big day for central bankers.
No kidding. Okay, thanks for that. That is CBC senior business reporter Peter Armstrong. Thanks, Peter.